Everything that you need to know about the StashAway's new thematic portfolio will be covered in detail. Coming up. Hey, what is up guys? I'm sure you must have checked out the portfolio and could be overwhelmed by the variety of choices you have. Well, fret not, because in this video I will do a deep dive into StashAway's thematic portfolio, covering details such as the overview of each portfolio and their underlying ETFs. And at the end of this video, I will also give you my final verdict as to what I think about this entire thing. This video took me more than 3 days to research and write, so I will appreciate if you can help me smack the like button down below. Thank you very much. It's going to be a long one, so feel free to skip according to the timestamps down below. And without wasting any more time, let's jump right to today's content. We're gonna kick off by looking at the technology enablers, and according to StashAway, this portfolio invests in artificial intelligence, blockchain, cloud computing, robotics, and semiconductors. I know, there is a lot of big words being used here, but that's the point of this video. I will simplify it as much as possible for your understanding. Anyways, if you have checked out this portfolio on their app, then I'm sure you will see that it is further divided into core and higher risk portfolio, which has a risk index ranging from 20% up to a maximum of 45%. So to help you out, I've tabulated them down in this Excel table, showing you the composition of each risk index, which I am sure will give you the perfect bird's eye view of this portfolio and the weightage of each ETF, as opposed to just blindly assuming they are all only differentiated by their weightage. I have said that because not only their weightage changes, some of the ETFs in the balancing asset section, which are the bottom half comprising of government bonds and etc., changes as you progress from left to right. As you can see, some of the ETFs are being removed as the risk index increases. I won't waste your time by explaining the various different government and corporate bonds in all three portfolios, because I've covered them before in detail in my previous video. So feel free to check out this video. I'll put a link down below for you. So from this table, we can see that there are 6 different ETFs covering the theme of this portfolio, which are arkw, botz, arkq, smh, blok, and skyy. When you increase your risk index from left to right, the only thing that changes is the weightage of each ETF in the portfolio. Having said that, let's dive right into the 6 individual ETFs here, which I've also made a table covering the salient terms that you need to know to gain a better understanding on each of them. The first ETF here is arkw, which is the ARK Next Generation Internet ETF. The fund provides exposure to innovative internet technologies, including cloud computing, big data, digital media, e-commerce, blockchain technologies, and the Internet of Things, IoT. Basically, what it means is the ETF covers any companies that has something to do with internet in their business model. For example, their top equity holdings include Tesla, which, hey, is an electric vehicle manufacturer, right? But Tesla is actually more than that. Their electric vehicle collects valuable driving data, which they then feed into their computers via internet. And through the power of AI and machine learning, they are now at the forefront of the R&D for the autonomous driving system, which ARK predicts their robotaxi segment's revenue will surpass the revenue share of their electric vehicle by 2025, giving them a potential of 2 to 5x their current share price of around $800 to $900 per share as of the recording of this video. Anyways, moving on, they also have Coinbase, which is one of the largest, if not the largest, cryptocurrency exchange in the United States. They don't only serve retail investors that hodl and waiting for cryptos to moon every single day. They also serve more than 9,000 financial institutions, which one of their clients, surprise surprise, is Tesla, in case you don't know already. Their third largest holding is Twitter, pretty self-explanatory. Teladoc Health, which is a virtual health provider that allows you to connect 24/7 with your doctor, physicians, specialists, and whatnot through mobile phone, internet, video, and etc. Unity Software, they are the developer for the software platform that creates 2D and 3D content for some of the most famous games that you all would know, such as Pokemon Go, Call of Duty Mobile, Cuphead, and etc. Their products have widespread application in the other industries, such as the architecture and construction sector, animation industry, and designing sector. And according to an article back in late 2020, it is said that Unity software is used to create 50% of all new mobile games. So if you just look around at how mobile and even PC games are in almost everyone's life, then that should be able to give you the perspective of how important Unity is in today's context. and maybe even far into the future when augmented reality is something. Feel free to check out the rest. Their general theme are more or less the same, taking advantage of internet to create and innovate products and services. Fund AUM and return are also pretty much self-explanatory. What I want to show you here is their beta and Sharpe ratio. Beta is essentially a measure of its volatility in relative to the overall market. Since the market has a beta of 1.0, anything more than 1.0 means the stock is more volatile, and anything less than 1.0 means the stock is less volatile in relative to the overall market. So the thumb rule applies. The higher the beta, the higher the volatility, which means higher risk and reward as a result. The Sharpe ratio tells you how much excess return you bear for holding a riskier asset. I will put it simple for you. The higher the Sharpe ratio, the better it is for you. But of course, all of these are just financial ratios and they have its flaw. So please take them with a pinch of salt and don't just invest based on these indicators. The second ETF we have here is botz, which is the Global X Robotics and Artificial Intelligence ETF, which their name already revealed to you that they focuses on companies that revolves around robotics and AI, such as for industrial robots, autonomous vehicles, and etc. Their largest equity holding is Upstart, which is a company that provides credit services. The way Upstart works is they collect the consumer demand for loans and connects it to their own network, and through the power of AI, they help banks to create lending products to consumers, which will then help the banks to reduce the risk and cost of lending. Second company we have here is Nvidia, which I am sure most of you must have heard about it already. Nvidia is one of the world's largest chip maker for all variety of markets, such as the graphic cards for computers and gaming console, chips for your vehicle infotainment systems, as well as the chips for data centers, which is essential for various internet companies such as Shopee and etc. to run their businesses. And in case you don't know already, they are also the supplier for NIO's autonomous driving system. The third largest holding here is Keyence, which is also a huge developer for factory automation sensors, machine vision systems, barcode readers, laser markers, measuring instruments, and digital microscope. So I will leave the rest for you. You should get the gist of the remaining companies in this ETF. Moving on, we have arkq, or also known as the ARK Autonomous Technology and Robotics ETF. This ETF focuses on disruptive innovation in automation and manufacturing, transportation, energy, AI, and materials. I know it's a lot to take in. Looking at their holdings, we have Tesla at the top and Trimble as the runner-up. Trimble manufactures laser and optic-based products, as well as global positioning system GPS products, and they serve various industries which include agriculture, architecture, civil engineering, construction, and etc. It's mainly a B2B business, so definitely not something that you would hear right off the bat from the news. The next company we have here is Kratos Defense, which is a defense and security company that develops systems, platforms, and technologies mainly for government defense. The software and systems that controls the fighter aircrafts, destroyers, and satellites, yeah, that's what Kratos does. Defense companies like this are usually pretty stable because they run on government contracts. I believe this share price for the past 5 years speaks for itself. Next, we have SMH, which is the VanEck Semiconductor ETF. This ETF has been around for quite some time now, and as its name goes, it mainly tracks companies that are involved in the semiconductor market. Their largest holding, TSMC, or Taiwan Semiconductor Company, is one of Apple's largest chip supplier. Your iPhones are all powered by the chips fabricated by TSMC. TSMC is a giant in the silicon business, definitely one of the most stable play any investor can have in their portfolio. The runner-up, Nvidia, we have covered this already. The second runner-up, ASML, is also one of the world's largest semiconductor player with about $330 billion in market cap, and that is as huge as the likes of PayPal, Disney, and Netflix. They are the world's only manufacturer of EUV lithography system, which is the world's most advanced equipment to fabricate semiconductors. And for your information, its top 3 customers include Intel, Samsung, and TSMC. So theoretically, if Apple needs TSMC, then TSMC needs ASML. So definitely a rock solid component to have in this ETF. The rest of them are also semiconductor players like Texas Instruments. They are the world's 4th largest semiconductor player. Intel, pretty self-explanatory. AMD, also a strong player in the chip design business that has a pretty explosive growth in recent years. And recently, they announced that they are going to supply the infotainment system inside the Tesla vehicles. That's about it for this ETF. Moving on, we have Blok, which is the Amplified Transformational Data Sharing ETF. This fund focuses on companies involved in the development and utilization of blockchain technologies. And in another word, they are highly correlated to the cryptocurrency world. For example, MicroStrategy, they are well known for being the largest institutional holder for Bitcoin. I believe this picture should be able to show you just how much of a Bitcoin hodler they are. Anyways, we also have companies like PayPal and Square, which also supports cryptocurrency transactions on their platforms, and some other mining companies and whatnot. All in all, if you are a firm believer in the blockchain technology, then obviously this ETF just covered all the key players that plays a key role in enabling and empowering this market. The last ETF in this portfolio is the SKYY, or the First Trust Cloud Computing ETF, and as its name goes, it has everything to do with the cloud computing industry. Cloud computing is the delivery of different services through the internet, and they can be categorized into three main types. Firstly, software as a service, SaaS. For example, if your company subscribes to the Microsoft Office 365 license, then that is all powered by cloud computing. Second type, infrastructure as a service. We are talking about IT infrastructure such as cloud storage, server, and networking resources, which are all delivered through cloud computing. And one of the most popular examples for this will be Microsoft Azure, which quote unquote is used by 95% of Fortune 500 companies. The third type is platform as a service, which is the most complex out of these three. Basically, it is a cloud platform that allows you to create software that can be delivered via the internet. For example, Salesforce, they help businesses worldwide to manage their sales, customer service, marketing, and etc. through their platform. Some of their most notable customers include Spotify, Amazon Web Services, Toyota, US Bank, and etc. That's it. When you combine all three types of the cloud computing services, then you have Amazon Web Services. Hopefully that gives you some idea as to why Amazon is so huge today, and their AWS segment is growing at a rate of 37% year over year. And some of its competitors like Alibaba and Tencent is also focusing a lot on their cloud computing business. So if anything, this cloud computing segment is definitely bound to grow larger as time goes by, because inevitably more and more businesses and customers will require services that are provided online. So that's about it for the first portfolio. Yeah, I've already told you upfront it's going to be a long video. Hopefully now you know why I've took so long to make this analysis video. It wouldn't make any sense if I were to just wing it through within a few minutes, right? Anyways, let's look at the second portfolio, which StashAway call it the future of consumer tech, which is again made up of 6 different ETFs. Let's start by looking at the first one, DRIV, or also known as the Global X Autonomous and Electric Vehicles ETF. As the name goes, this ETF invests in companies involved in the development of autonomous vehicle technology, electric vehicles, and EV components and materials. And when you talk about EV, inevitably you will talk about Tesla, Nvidia, and Alphabet, which is Google. If you don't know already, Google has invested for over half a decade into this autonomous driving technology company called Waymo. However, just because it's in the autonomous driving space does not mean it is the direct competitor of Tesla. That's because Waymo still relies on the real-time data from LiDAR and sensors to predict movement as you drive on the road, whereas Tesla relies on state-of-the-art computer vision and machine learning, which is backed by the humongous amount of data received thanks to all of the Tesla EVs driving out there. Hence, the cost advantage of Tesla's EV is miles ahead of any of its competitor, allowing it to top the chart when it comes to its sales number. Anyway, since we are talking about ETF here, there is no need for you to choose any company over here. You are being presented a whole bunch of them anyway. The next ETF in line is the ARK Innovation ETF with the ticker symbol ARKK. This ETF is probably the epitome of thematic portfolio, because its fund's main objective is to provide investors with a broad exposure towards disruptive innovation. And by broad, I mean they cover a vast array of industries. For example, AI, robotics, energy storage, DNA sequencing, and blockchain technology, which according to ARK Invest claim will change the way the world works and deliver outsized growth as industries transform. If you look at its technology breakdown, you will see that it is actually pretty well spread out across cloud computing, digital media, e-commerce, gene therapy, big data and machine learning, Internet of Things, blockchain and P2P, and etc. All of which are themes that many people believe will be what the current world today is moving towards. And to support that mission, then of course ARK Invest has to put their money into the leaders of each respective industry. For example, Tesla in the EV and autonomous driving industry, Teladoc, whom is the leader disrupting the medicine industry, Coinbase also claimed to be disrupting the brokerage industry should the blockchain technology be accepted worldwide, Roku disrupting the television and advertisement industry, Unity Software also disrupting the film and TV production industry thanks to its 3D content creation tools, Zoom, who doesn't know Zoom? Anyways, the rest of them are pretty self-explanatory. If you are always keen to look for the next Tesla of the other industries, then this ETF would arguably be one of the best places to start your research. Moving on, we have finx with the Global X FinTech ETF. Again, as you can guess from its name already, it is focused in fintech companies that helps to transform established industries like insurance, investing, fundraising, and third-party lending through unique mobile and digital solutions. What does that mean exactly, right? Well, very simple. Let's say you are running a business and you're used to accept cash as a form of payment, and then you have to record it down in your logbook, then you have to manually key into your Excel for accounting purpose, and then you have to adjust your stock inventory and balance sheet and yada yada. Everything is done manually and will be very cumbersome, right? What if I tell you all of that can be updated and done automatically at almost real time if you pay for services provided by companies like idna, where you can pay your vendors or receive hundreds if not thousands of payments globally in multiple currencies while integrating your business accounts with accounting softwares, or get a business loan within days or even hours thanks to the automated credit scoring capability. That would inevitably result in higher efficiency in your business because there are less time to waste, which means more money to make with lesser resources. And that is essentially a huge part of the problems that companies like idna, Intuit, Upstart, Square, and etc. is striving to solve. Their goals are pretty simple, but to achieve that, digitization of various verticals such as vendors, suppliers, distributors, stores, and etc. needs to be included into this digitized ecosystem, and that is what this ETF is focusing on in a nutshell. Of course, I'm probably oversimplifying things a little bit here, but you get the gist. Just pull out the business model for the top 10 companies in this ETF and you will know what I mean. Next, we have arkf, or the ARK FinTech Innovation ETF. Again, very similar to the previous ETF in the sense that they are also investing in fintech companies that potentially changes the way financial sector works through the introduction of technological enabled new product or service. One little tweak here, they are fintech companies that can disrupt existing businesses through tech. For example, in this list, we look at Zillow. Zillow is an internet-based real estate company where you can buy, sell, or rent properties, and for most of you Malaysian viewers, it is equivalent to the likes of Property Guru but on steroid. If you have been searching or have searched for properties online in Malaysia, then you will have known that there are lots of donkey agents putting in fake prices, showing you something that is no longer available but just to bait you to contact them, and all of that pain being amplified by constantly asking you to view their units which you have no interest to begin with. Yes, Zillow avoids that by completely removing the middleman and replace them with technology. And on top of that, they also make getting a mortgage much faster and much simpler thanks to the integration of their own Zillow Home Loan and Zillow Closing service as part of its ecosystem. And not only that, they also recently ventured into direct purchase and sale of homes through their own Zillow offer, where the company buys a bunch of houses and resell them to the US home buyers, which effectively removes the need of any middleman. So if Zillow have control of the entire verticals in the real estate market, presumably, then they are probably on track to be the next Amazon that controls the logistics and e-commerce market. Well, of course, not all things are guaranteed, but I hope you see what I'm trying to say here. Moving on, we look at OGIG, or iShares Global Internet Giants ETF. This ETF is also pretty self-explanatory in the sense that they invest in some of the largest global companies that derive most of their revenue from the internet and e-commerce sectors. I mean Google, Microsoft, Amazon, Facebook, Sea Limited, which is Shopee's parents by the way, Meituan Dianping, one of China's largest shopping platform, something like a combination of Shopee plus Grab plus TripAdvisor plus Groupon plus Airbnb. Anyways, you get the gist of it. The rest of the companies here are again huge internet giants which you would have heard before, so I won't bother to waste your time here. The last ETF in this portfolio is ESPO or VanEck Video Gaming and Esports ETF. For those of you aunties and uncles that don't know what that means, have you ever noticed your kids or friends got so addicted into their mobile games and computer games? Yes, there you go. Esports is essentially that, but a group of people competing for a huge prize pool that can go up to an absurd amount of money. Just to give you a little bit of context, a few weeks ago in the middle of October, Team Spirit, which is a group of Russians, just won 18 million US dollars as the champion of the International Dota 2 Championship. If you split the amount, that's like about 3.6 million US dollars of cash prize won just by playing in one single tournament that ran for about 2 to 3 months. Now, of course, I'm oversimplifying it. You don't just win that amount of money just by playing computer games for a few months. You will need to probably dedicate your entire life and soul to even come close to a fraction of that amount of money, let alone win it. Trust me on this one, I was once a semi-professional Dota 2 esports player in Malaysia, but of course I got knocked out very early in the top 64 team of the Malaysian Cyber Games back in 2015. I lost to the champion of the tournament, okay, but whatever. The reason why I'm sharing this is because I have been lingering in this industry for quite some time and see that there is always a potential for growth because people are getting more tech savvy and have more access to the internet, and inevitably games are something that you tend to fall or incline towards, or at least for the younger generations, and that's just how entertainment has shifted in the recent times. Though I must say, people are rapidly moving towards mobile gaming instead of gaming on computers, and according to Statistica, there's over 2.4 billion mobile gamers in 2020. It will most likely reach 2.7 billion by next year. The gaming market will reach 165 billion US dollars worldwide, and that's 51% of the gaming industry revenue, making mobile gaming the most popular and lucrative industry in gaming. So if 165 billion is 51% of the gaming industry, then the gaming industry itself as a whole would be somewhere around 323 billion US dollars, and in the context of total addressable market TAM, that is larger than the market size of fast food restaurants in the US. Not sure if that's the best comparison, but anyway, whether you like it or not, the esports industry has been growing its viewer base by a steady 50-ish% per annum for the past couple of years, and is expected to continue to do so. So if you understand how the advertisement industry works, that itself presents a whole new world of opportunity for brands and sponsors to advertise and grow the industry even further. Anyways, I hope that gives you a little bit of context for the companies included in this ETF. I mean Nvidia, chip maker; Tencent, game developer; AMD, chip maker; Garena Games; Nintendo, Feel free to check out the rest of the holdings, should be more or less the same as they are all enablers in the esports industry. Alrighty, that is all for this portfolio. Hopefully you gain a better insight on them. I will give you my opinion on them in the verdict section later. Now, we move on to the last thematic portfolio, which is the healthcare innovation portfolio. And I got to say up front, this portfolio has everything to do with biotech, genomics, and pharmaceuticals, which are things that I am not really well versed in, and I won't even pretend that I understand them fully. Anyways, just to break down genomics for you, it is essentially talking about genomes, or to be specific, the genes and DNA of an organism. For example, human, animals, plants, we are all examples of living organisms. So when you relate healthcare innovation and genomics, then people are usually referring to genomic sequencing, which is essentially one of the processes that allows scientists to identify the virus and monitor how it changes over time into new variants. For example, according to the WHO, in December 2020, South Africa detected the Beta variant, and in May 2020, the Delta variant, thanks to robust genomic surveillance. Genomic sequencing has been very important for the COVID-19 response. It took less than 48 hours of knowing about the new variant to do that, and it was the same with the Delta variant in the third wave. According to the white paper published by ARK Invest in late 2020, NGS, or also known as Next Generation DNA Sequencing, enables clinicians to gauge an individual's risk of cancer, treat diagnosed patients, and monitor disease recurrence more precisely. And when you come to think of it, people are still suffering from cancer. There is no known cure to cancer, and that's because cancer in itself is an umbrella term for more than 200 diseases. If you think 200 is a lot, wait till you know that there are a huge variant of genetic mutations for each and every cancer. So just because a drug works for this patient, it may not necessarily work for the other patient, and that in itself presents a very unique use case where technology and the healthcare industry can come together to study and detect these mutations and hopefully come up with the solutions for that particular disease. Anyways, that gives me the perfect segue to the next but not less important process in the genomics industry, and that is the gene editing process. In a nutshell, gene editing is a technology that allows scientists to basically edit any organism's DNA, which is dubbed to be the key in the prevention and treatment of human diseases. But currently, most of the research are still done on animals because scientists are still working on to determine whether this approach is safe and effective for use in people. And that said, a new branch out of the gene editing process is the CRISPR technique, whereby it has been commercialized by many companies to deploy novel therapies, which is essentially using technology to come up with a new treatment in hope to treat something unique like a particular cancer patient while limiting side effects, and also increase R&D in drug discovery, agriculture, diagnostics, chemicals, and material sciences, all of which are important biotechnology that advance us human into the future. ARK claims that the genomic age could create trillions of dollars in equity market cap by 2024. Advanced molecular diagnostic tests could command tens of billions in annual revenues, while connected medical devices generate hundreds of billions, and living drugs in oncology, aka the study of drug, alone more than 200 billion US dollars. Whether or not if that is true, that is not for me to speculate, since I can't fully understand the healthcare industry as much as a scientist do. So please take those claims with a pinch of salt, because understandably the publisher of these white papers, aka ARK Invest, is also profiting from you investing into the ETF. So inevitably there could be a conflict of interest whereby information could have been selectively presented to you for reasons that I'm sure you can think of. I won't bother to try going into the companies in these ETFs, so feel free to pause this video if you would like to take a closer look into each and every one of them. Hopefully this data that I have compiled can help you with your research. Now, welcome to this section where I will share with you my final verdict on StashAway's thematic portfolio. Before I even touch about any of the portfolio, we'll need to make clear about the expense ratio or the management fee that you are paying for these portfolios. According to StashAway's website, they say that the annual management fee for thematic portfolio ranges between 0.2% and 0.8%, which is also in line with the fees that most of us are already paying for the general investing portfolio, as you may have known already. Traditionally, and even until today, thematic ETFs or sector-specific ETFs usually have higher expense ratios of roughly 0.6%, as shown by this data from ETF.com. So in the context of expense ratio, we need to give credit to StashAway for not imposing too much markups, although to be honest, I believe most of us are in the 0.8% bracket, so 0.2% markup, not too bad by all means, but of course, if your goal is to pay the least fee, then obviously direct investing with brokers like Interactive Brokers would be the much wiser choice. But anyways, investing via robo-advisor and direct investing with a broker is two completely different things. You are investing with robos to help you automate your investments, so inevitably there will be a premium to be paid. Next, we talk about the idea of thematic portfolio in general. To be totally fair, I was also once got stuck into the idea of investing into disruption and technological advancement and innovation and whatnot. Don't get me wrong, technology and innovation, really cool ideas. I am a huge believer of tech, which is why a huge bulk of my stock portfolio is actually made up of US blue chip stocks, no doubt about that. However, another fact stands true. Just because it is a good company or a good idea does not make it a good investment. You still need to look at the valuation as a whole to finally determine whether or not it is a good place to invest your money for the long term. Morningstar, a well-known fund research house, has actually made a research early this year which shows that the thematic fund's asset under management more than tripled to more than 160 billion US dollars by the end of March 2021 from about 49 billion US dollars at the end of December 2019. As you can see from the meteoric rise in in this chart, which of course it is partially attributable to the huge amount of money printing by the US Feds, but let's not go down that rabbit hole today. And also they have found that the long-term performance for thematic funds are best described as underwhelming. If you can see in this chart, the red stands for underperformance against the Morningstar Global Market Index, which is basically equivalent to an all-world ETF, and the orange stands for funds that have closed down. So if you eliminate the red and orange from this chart, you will see that in the 10 to 15 year period, less than 40% of the thematic funds survive and outperform the all-world index. But then of course, this is a high-level approach of viewing things. There are good funds and there are also bad funds, so please take this data with a pinch of salt. Having said that, what do I think about this 3 thematic portfolio by StashAway? Well, as a robo-advisor, this portfolio is inevitably a combination of various ETFs plus balancing assets in the form of bonds, commodities and whatnot, which I think StashAway also recognizes that the inherent risk of chasing trends or futuristic themes can be a little bit more risky compared to investing in the existing assets, which is why, in my opinion, balanced out by the less volatile nature of the balancing assets. And also, you should know that one ETF usually consists of at least tens or hundreds of companies, and if you combine say 6 ETFs into one portfolio, that is a massive diversification. And in another word, you are actually buying into a whole bunch of winners as well as a whole bunch of losers. And also, some of the ETFs have a restriction in place whereby they won't invest in one particular winner too much, which will exceed a certain percentage of their asset under management due to risk management. So inevitably, their excess money that investors suddenly pile into them in 2020 and 2021 will be forced to be invested into, well, again, a bunch of winners as well as a bunch of losers. And when you average them out, you might find yourself in a spot where you just underperform against a broad market index such as the S&P 500 index. If you ask me, I would slightly favor the idea of investing into the healthcare innovation portfolio, just because that sector presents more potential as the general public still have not grasped the full idea of the genomics industry, which in itself presents an upside, higher risk, higher reward, right? As for the other 2 thematic portfolios, I am personally not that keen because I would rather invest directly into their individual ETF via interactive brokers, or I would cherry pick the clear leader in any EV or fintech or esports and whatever industry that is, as opposed to ultra diversifying my money into all of them. Fintech, super crowded space. Blockchain, very tricky. Decentralized finance have a lot of hurdle before it even sees blue sky. Autonomous vehicles and EV, I don't see why not just Tesla instead. Anyways, at the end of the day, it is your money, so it is up to your personal preference as to which portfolio or investment assets suits your need. There is no one right answer for everyone, and my job here is to share with you what I know in hope of helping you to make a better educated decision. One last thing before I end this video, I know people have been saying that finance creators are only profiting from giving away referral links, which is true to some extent, but I will be honest with you, what StashAway pays me is barely enough for me to pay my electricity bill. So if your friend have one, use their referral link. It doesn't bother me at all, so please don't feel obliged. Full disclaimer ahead, I am not a financial advisor. I could be right and I could be wrong as well. I am just another guy on YouTube, so please do your own research before investing your hard-earned money into anything. Anyways, I hope you like this video. A little thumbs up for this long-ass video would go a long way for the YouTube algorithm. And with that said, thank you very much for watching. Stay safe, stay invested, and as usual, I will see you in the next one.